So here we go. Just want to do a quick video here on something that I think gets brushed over quite a bit and doesn't get, I don't think anybody really takes time to break it down and really explain some of this lingo, the jargon that we use in, day-to-day trading and futures and things like that. So just wanted to take a quick minute here to break some of those terms down and just give you a quick overview of things that I kind of use on a daily basis and most anybody that's going to trade grain is going to use. First thing being, futures. So futures is basically what we use as a risk management tool, and when we say futures, we mean the futures price. And a futures contract is a contract obligating the purchase or sale of a commodity, and like I said, mainly used as a risk management tool. And with most futures contracts, those are offset prior to delivery. And all of our futures contracts are traded on the Chicago Board of Trades, mostly using your grains, your corn, soybeans, and wheats. The next term is a basis. We've covered bases in past videos, but basis is basically a price that is set by your local supply and demand. And when you're talking about basis, the terms that get used a lot are over and under. So I'll say we're 40 over today, and that's 40 over the futures price, and that's just means it's a positive basis. So in addition to the futures, and conversely, the term is under. So we'll 50 under. So that means subtract 50 from the futures price, and that's a local cash price. With that in mind, meaning that there is no basis that the local market is equal to the futures price is a term that we use called option or even the board. And you take the futures plus basis, and that is the cash price. That's the price that a producer is going to get for their grain, basically, whether it's picked up or delivered. That is their cash price. So it's pretty self-explanatory. Spot price is basically the current price for immediate delivery. So today, right now, the spot price is that at that exact moment. And a forward price is basically the contract price for a future delivery, whether it be tomorrow or a year from now. That's basically a forward price, is a cash price for a future delivery. Basis contract is a contract where the basis is set but the futures are not. So if you think that corn is going to go up in price but the local supply is going to basically outweigh the demand, i.e. basis go down, that's when you lock in a basis contract and leave those futures to gain, hopefully, in the future. On the other side of that is an HTA, or a hedge to arrive contract. That's where you think the futures are going to go down but the basis will go up. So you'll lock those futures in and let that basis rise, hopefully. A spread is something that we use a lot when you're starting to store grain. But a spread is basically the difference in futures months between different months. So the spread from, say, November to July or January to March, it's always looked at on basically what the market wants you to do. So if the market wants you to carry grain, you'll see that spread. So the back month or the farther away month is trading a higher price than the closer one, which brings us to front month and back month. So front month is basically the month that you're currently trading off of for the current delivery period. So right now it's June 3rd, so we're trading July futures, which up until the end of June, so June 30th, then the delivery period starts and we will go to the next month. In most cases is September. So the front month, near month, spot month is your current futures month that you're trading off of. On the other side is deferred. Deferred and back month is farther out. So, right now a deferred month would be January or July. Carry, in reference to spreads, is basically, as I described, that there is the market basically is paying you to carry that grain. So the front month is trading at a discount or less than the back month. And on the other side of that is an inverse in the spreads, meaning that the front month is trading at a premium to the back month. In that case, the market really wants that grain now, so that front month will be trading higher than the back month. And bids. Bid is basically the price that the market wants to buy at. So whenever I want to buy something, I'll bid, and whenever I want to sell something, I'll ask for it. And you'll see that as far as futures go, it's a bid-ask spread on what the market wants to buy at, what the market wants to sell at. Most times that's, you know, in your corn, soybeans, your highly traded stuff, it's pretty close. It's within a quarter tick to a half tick. But if you start getting out into farther months, like right now, D's 23 corn, I think that bid-ask spread on that is roughly 5 cents, because there's not a lot of liquidity there. Something else that we use a lot is long and short. So if I'm long something, that is just a term for me owning it. So at harvest, I'll go out and I'll buy grain, so I own it. That makes me long that crop. On the other side, if you sell forward, you're short something. So if you go out and sell a bunch of wheat that you don't own yet, that means that you're short. And this is a case for cash, for basis. You know, you can be short basis, meaning you've sold basis that you don't own yet. And it's a generic term that's used across the markets. And finally, bullish and bearish, they're just descriptions of a feeling. So if I think the market's going up, if there's a major drought in the Midwest and everybody's buying cornflakes tomorrow, I'll be bullish the corn market. If the US goes out and plants 97 million acres in record time and it's all up and looks good, I'm going to be bearish that corn market, meaning that I feel like it's going to go down. And last but not least is everybody's favorite topic, in options. And options are basically derivatives based on underlying commodity futures that give you the right to do something. Whereas a futures contract is an obligation, meaning if you carry it to basically delivery, that you have to take that grain in. Whereas an option is an option, or the right to basically buy and sell at a certain price. With that, a put is the right to sell at a predetermined price. So you want to be able to, if you're bearish a market, you want to be able to put that in, or put that into the market at a higher price. And that's why you would buy a put option. If you think the market's going up and you want to call, basically buy out of that market at a predetermined price, that's when you'll buy a call option. So a put is when you want to sell, and a call is the right to buy. So call if the market's going up, put if the market's going down. And the buying and selling in those can become confusing, but just wanted to touch on those real quick, because options are another animal for another day. But I hope you enjoyed this video. I hope this cleared some of that up, and we'll continue to grow on this going forward, but just wanted to put this out there, and hopefully it helps somebody. Thanks.